Hey everybody, Anthony Ruffalo, a certified financial planner. Wanted to give you a little bit more background and some color into the economic indicators that I follow. I have been entrusted to manage money for clients. I don't pass it off to a third party. I do everything here in-house. We don't pass it off to third-party asset managers or separately managed funds anywhere. So first and foremost, US GDP. US GDP, we're looking at 2.5 to 2.75% for 2019, which means really that's the absence of a recession for 2019, which will likely support equity markets. Consumer spending, the consumer makes up 70% of that US GDP number. Strong equity markets make people feel wealthier, and that supports consumer spending. So again, it may support continued equity growth in the equity markets. CapEx spending or business spending, we're still seeing CapEx spending from the corporate rate got cut from 35 down to 21 last year, and we're seeing companies spend in the capital markets. Let's see what else we got. Labor markets, which is unemployment. So the Fed's dual mandate. What part of that dual mandate for the Fed is to for low unemployment or full employment, so to speak. We're still at historical lows on unemployment, which is, wage gains are supporting consumer spending, which again in return should support equity markets. We always say may and should because there are no guarantees with investing. Inflation is well under control. The second part of the Fed's dual mandate is the inflation target. Right now they're targeting about 2%, and we're not seeing, they're actually having a hard time hitting that 2. So we monitor the inflation rate. Inflation is very important because for my people that are retired, living on portfolio withdrawals and possibly a fixed income, inflation erodes away at your spending power. Anybody who was alive in 1980 knows that the cost of gas in 1980 or a gallon of milk in 1980 versus now is significantly different. That's our classic inflation example. US dollar is strong, which that creates a headwind for international and emerging markets. Stronger dollar because they got to convert back to our currency here in the US, so that could cause some problem. Global GDP growth is expected to be relatively flat. We're looking to the IMF to possibly do a little bit another round of quantitative easing for the global equity markets. So those are just a few economic indicators that we're following as that relates directly to asset management, and then that relates directly to portfolio management. Thank you.